Hello, everyone. Today on the final bar, we'll talk market rebound, a little bounce back up to the upside with small caps really leading the way higher today, up almost 4% today. So the S&P, after really selling into weakness into the weekend on Friday, now coming back pretty well with stocks like Boeing up significantly along with airlines and others, some of those beaten down groups in industrials, materials, and elsewhere. Every Monday, we hit the market from three directions: top down, sector rotation, bottom up. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close to break down the markets from a technical, behavioral, psychological, evidence-driven perspective and connect the short-term of what we're seeing to the long-term trends that are evolving over time. I was talking to a contact of mine over the weekend, and he asked about daily versus weekly charts, and I was showing a lot of daily charts, especially on the show recently. And I think the reason why I've shown less and less weekly charts and more daily charts because of the time compression. Right, things have been more volatile, things have fluctuated a lot more quickly. There's a lot more movements, key levels being tested, and so I think the daily charts give you a lot more clarity on that short-term supply and demand. Let's not lose track of the fact that the longer term charts, the weekly charts, even the monthly charts can give us a better sense over time of how those long-term trends have evolved. Now, coming up on this show and elsewhere on StockCharts TV, we have fantastic guests to help us make sense of things. Earlier today, we premiered our latest episode of Behind the Charts. That's our show where one of us sits down with a strategist, trader, technical analyst, someone to understand their process. We sat down with Louis Navalier of Navalier and Associates. He's not a technical analyst. He's a fundamental and quant sort of mashed together. We had a really good discussion about his discipline, his process, how that relates to the charts that you and I talk about on the show every day. Tomorrow on Tuesday, Jim Smith from GAN Analysis is joining us. On Wednesday, Scott Smith, who's the technician at briefing.com, will join us. This is a shorter week, right? So it's a holiday week. We'll be taking Friday off with the markets on July 3rd, and hope everyone has a great 4th of July holiday. Coming up 2 weeks from today, the week of July 13th, is Charting the Second Half. That's a week-long celebration of market outlooks on StockCharts TV. We'll be looking at the first half of the year and really focusing on the second half of the year and what may be in store, including some market outlook panels, some special guests, special presentations, and every show will have a bit of a market outlook feel to it, a little different than normal. So check that out all the week of July 13th. So as I mentioned in the introduction, Mondays, I love them because we deal with market awareness from three perspectives. And these are the three parts of how I think of my process as a technical analyst. The top-down macro, what's the big picture saying? The sector rotation, what sort of themes can we see from sectors and groups and how they relate? And then bottom-up stock picking. And I think each one of those three is really important. I'd encourage you as we go through the charts together today, think about your own process and where you might be able to upgrade things in terms of using the charts to help visually understand what's happening. So let's start at that top level with the top-down macro with our market recap today. So the S&P finished strong today, rallied out of the open, which was pretty impressive, kind of came off in the first 15 minutes, but then rallied very nicely through the lunchtime hours. Came off before 3, but then really rallied to close at the highs of the day, just above 30.53, which is up almost 1.5% from Friday's close, which was pretty depressed. Worth noting, we did not get above Friday's open. So again, even though a nice bounce, we haven't really retraced much of that. We just sort of chipped away back at the losses we had on Friday. The Nasdaq was up a little less than that because technology was actually one of the weakest three sectors today, which is a little unusual. Where there was leadership was the mid-cap index up 2.3%, 2.4%, and then small caps, which finished up almost a flat 4% from Friday. They really opened higher and then just accelerated. So this was certainly more of a risk-on feel to today. Now, again, going through the end of this month, end of this quarter. We have the Russell rebalancing. We have a lot of shifting around. So the volume was really heavy on Friday. A lot of that relates to that, funds that have to sort of recalibrate calibrate things. The move we saw today is not what you would normally expect with small caps, right? Something that was up a lot. You'd expect people to be rotating out of equities into somewhere else. So today was a little more of a risk on type of feel. The VIX back down to just above 32. Now, the bond market's actually relatively flat. The TLT was down 0.3% and 10-year yields around 64 basis points. Gold actually really just fluctuated around the zero level, finished essentially flat for the day. Oil was up a little more, up over 3%. The energy sector, though, not in the bottom half of sector returns for the day today. Let's look at a chart of the S&P because, again, we're going to go through each of the three major categories of technical work over the course of our show today. So we'll start with the daily chart of the S&P 500, and this is sort of the base case that I've been, thinking about, talking about. An uptrend is a pattern of higher highs and higher lows. As long as the high prices keep getting higher and the low prices keep getting higher, the market is in an uptrend, or whatever asset you're looking at is by definition in an uptrend. The pullback that we had a couple weeks ago, second week in June, still was a higher low from the previous pullback. So it's not like that was anything different than an uptrend. What's interesting though is then we had this swing high around 3150, which we tested 3 different days over about 6 or 7 trading days. Since then, we've now pulled back and now potentially retesting lows. We're certainly retesting support at the 3,000 level, which is the 200-day moving average around there as well. So we are at a key decision point right now. We're entering this sort of orange colored area that I've highlighted on the charts, which combines the 200-day moving average, the 3,000 level, the low from about a month ago. This was the low from, maybe 3 weeks ago from the second week in June. Also lines up with the low we had previously. Also the 38.2% retracement levels just below 2950. So all of those are sort of in this range. So you could expect the S&P to find support here and bounce higher. That would make perfect sense. You'd be looking for an RSI to remain above 40 during that period. And if that happens, this is maybe a very viable bounce on the next wave higher. But we've now established a lower high, which means if we break below this low, which is around 2960, 2970, that would confirm the pattern of now lower highs, lower lows. And what that tells you is the risk for further downside is certainly magnified relative to what it is before then. So we're right at that point. Today was a very reasonable bounce back above 3,000, back above the 200-day. All of that makes sense. The question now is, what's the next day hold in the remainder of this week? Do we continue to roll over, push down through that key support level? And I think if we do, I think if we get below 3,000, we start to test those lows. I think you could see selling accelerate very quickly because people will get nervous about further downside, and then it perpetuates all on its own. You don't even have to get in the way of that. Looking elsewhere at sort of the macro picture, and then we're going to rotate to some of the other things as well. Looking on Friday, we talked about in our Mindful Investor chart list when we did the Wrap the Week session, we talked about the cumulative advanced decline lines. And here the S&P on a closing basis has not breached 3,000. That's very important to pay attention to. But if you look at the cumulative advanced decline lines, sort of looking one level below the hood at the S&P, you can see 3 out of the 4 of these that I look at have already broken down through their swing low. So while the S&P has held up, while the cumulative advanced decline line has held up, the cumulative advanced decline lines for the New York Stock Exchange, for the mid-cap index, and for the small-cap index all have actually made new swing lows, which means those charts are all lower highs, lower lows, suggesting a downtrend. Now, what's interesting is the last time this happened was back here the second week in May, and soon after that, we resumed to the upside, and it was sort of an all clear. So again, this is not saying we go to zero. It's not saying the S&P goes to 2,400, but it's telling you, it's showing the characteristics that are in line with steeper downtrends. And you have to wait to see if we hold support, or if it ends up being more like May, more of a briefer pullback before further downside. Want to just finish up the macro perspective, looking at the broader indexes. I just wanted to point out today, all the China-related ETFs down at the lower end of the list, if not at the very bottom. So Hong Kong, the EWH, the 2 China ETFs we follow a lot, as well as Japan, all in the lower end of these. So If you look at the FXI, you can see that it's testing resistance. This is the same as a previous resistance level from the beginning of March. We retested that in June, and now rolling over just a little bit there. So, interesting to see some of those ETFs that had rallied really, really well up to resistance, not able to eclipse them, and now today the only ETFs really in the universe that we follow that were down below zero were those related to China and Japan. Let's continue on with our next segment called sector setup. So now that we've talked about the big picture, understood some of that, short-term weakness, but overall, again, continuing this uptrend pattern that we've seen over the longer term, let's look at the 11 S&P sectors, how they're rotating around the benchmark in the middle. We're going to start with the RRG. Julius DeKempener created this. He's one of our fellow StockCharts contributors. Check out his show, Sector Spotlight, if you want more color on how to use this sort of visualization. But we're looking at the 11 S&P sectors and how they're rotating around the benchmark here at the zero line. What's happened over the last 6 weeks or so is you've seen technology sort of, the strongest of the 11 sectors on a relative basis. And we know that because it's furthest to the right. And we've seen it actually hover around this line between the leading and weakening quadrants, which suggests that the momentum's starting to slow down a little bit. But overall, it remains the strongest point out of the 11 sectors. Contrast that with something like healthcare, which on a relative basis, using this methodology, has really rotated southwest, sort of a direction of negativity, really underperforming, and other similar sectors, consumer staples, utilities, all sort of in that weakening direction. In terms of what has joined technology in the upper right, consumer discretionary, communication services, and now materials, all in the leading quadrant. It's interesting to see some of these actually rotating down a little bit, which again, still means they're outperforming, but sort of the rate of that is slowing down. The momentum's coming off a little bit. So it speaks again to the resilience of technology, resiliency of just continuing to outperform on a long-term basis. The things that are really interesting, or the sectors that are interesting to me, are industrials and financials, kind of coming out from, with the deep in the lagging quadrant up into this improving quadrant. They've still been underperforming. And what concerns me with things like the XLI, if you look at Boeing, huge percent swings coming out of extreme lows. So Boeing was up at some point 10% today. I didn't see at the close how far it finished up, but significant bounces. But that didn't really change the characteristics of the chart. It's been a really choppy stretch. We're going to look at financials in a minute, and I think some of the more questionable charts I saw in my bottom-up analysis were certainly in the financial sector. We're going to look at the XLF here in a second, and you'll see what I mean when I talk about its inability to eclipse any sort of meaningful resistance levels. Let's look at those 11 S&P sectors. Here we're using the candle glance page, which allows us to visualize all 11 of those together, and then the spiders over here. So now that we've seen that rotation, let's look at the big picture and see how many of these sectors are above their highs from earlier in this year, January or February. And at this point, it's really only one that's really right at that point, which is technology. So tech, the XLK went above 100 here in February, sold off into the March lows, then retested it. We're right back just above that key 100 level as well. We're almost identical to the peak that we were in February. So this is one of the few that actually made, if any, actually it's the only one, as I'm glancing at all the images. No, sorry. I was going to say, I thought consumer discretionary made a high as well. So tech and consumer discretionary are the only two sectors that made a higher peak that have eclipsed their February high. Both of them sort of, the XLK now testing that same level. The XLY has actually gone back below it. Let's start with the chart of technology. So again, what impresses me the most, you see this big green arrow that every couple of weeks I just kind of, open up the annotation. I just bump the arrow down a little bit. And the fact that I haven't had to change the direction of the arrow, the color of the arrow, or anything about it for a while now speaks to the consistent outperformance of tech. And as I mentioned before, this is the type of thing I would consider sort of a core position. It's hard to, question the outperformance of technology at this point until proven otherwise. These stocks just continue to do well, both in bull phases and in bear phases of the overall market. Contrast that a little bit with consumer discretionary. You can see, looking at the two charts, this one's pulled back a little bit, and this one's in almost sort of a pennant pattern of lower highs and higher lows. And that's sort of a pattern when you have a big run in a chart, and then you have this sort of parallel, not really parallel, sorry, sort of this coil pattern of lower highs, the highs coming in, higher lows, the lows coming up. It didn't quite have that until today because it came off of a lower point. Now you really have this pennant pattern, and what you do is you draw a trend line using the highs, you draw a trend line using the lows, and you see which way this price breaks out of it. And whichever way it does, more often than not, that's the momentum. You think of this as buyers and sellers sort of hitting an equilibrium. We're sort of in agreement of where the XLY should be. And then buyers or sellers take control, or to put another way, the buying power overwhelms any selling, or the selling pressure overwhelms any buyers that might be coming in, and one side or the other sort of takes control. And that breakout is what usually is meaningful. This comes to mind John Bollinger's techniques using Bollinger Bands. We have a narrowing of volatility, sort of an equilibrium, then you wait to see which way this breaks. So I think the XLY is at a really key point here. It's sort of round tripped back to the February highs. The question is this the consolidation before the next leg higher, or do we break to new lows? And I think whichever one does, I think that's going to be a key direction to follow. And that's the area of that's the direction of least resistance, I would think, going forward. I mentioned financial, so I just wanted to hit on a couple other sectors here. I think the XLF is at a really key point as well, testing support. So the XLF rallied to its 200-day, failed there, right? So was not able to really eclipse the 200-day, has now bounced off of the 50-day moving average, and it's at the a confluence of support here, right at that 38.2% retracement level. That's taking this entire range from February to March. You can see that we rallied up to 38.2%, got above it a little bit, kept pulling back. We then bounced through it, came above the 61.8% retracement, hit the 200-day, now have come back down, and now we're testing. This is sort of how Fibonacci retracements tend to work. You tend to think of it when the price is within a range, that's where you look for key support and resistance. We're right at that point, and also at the upper end of this gap that we saw at the end of May. So we're at a key point. If this is able to hold, I think you could see some of these charts improve. I think you could see the market overall with a little more limited of a downside potential, because we're able to hold support here. But if you see ETFs like this break below 2250, break below support, break below that last one, then it measures down to 20 on the XLF, which would be the low from mid-May. That certainly could push the overall market down a little further. Just want to finish very quickly by looking at the utilities sector. And as a reminder, I think this is one that the relative strength has just been unimpressive. So when you look at the XOU, overall making this pattern of higher highs and higher lows, but the relative strength is what absolutely kills you. So don't get too caught up just looking at the price. Make sure we're looking at the relative line, and you can see the chart here versus the XLK, for example, going up and to the right. You want to lean more into those sectors, demonstrating their ability to outperform. We need to take a quick commercial break. Back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is your host, Dave Keller, here at StockCharts.com. As a reminder, we love to hear from you, love to see your questions. A number of you over the last couple months have just sent some beautiful charts showing what you're looking at and asking some questions about it. That is a way to do it. Just take a snapshot of your chart, email it to us at thefinalbar@stockcharts.com, or just post something on Twitter at FinalBarSCTV is our handle. Just tag us in a comment. We'll gather all of those. We'll do another mailbag segment tomorrow. We'd love to answer one of your questions during the show. Our next segment is called Shifting Stocks. And as we've talked about in previous weeks, part of my weekend routine starts on Fridays, getting ready for Friday's show, looking at the macro charts. And then over the weekend, looking a little deeper at, more deeply at sector charts, and then also individual stocks. And I try to go through the entire S&P 500 every Sunday as a way to just see what I can draw out of those individual names, see what sort of patterns, what sort of themes emerge. And I usually end up with a chicken scratch of sorts in a notebook that I've kept for a while, just with some key charts to pay attention to. I'm going to go through as many as we can in this little moment together. And again, some of these represent some potential short-term or long-term ideas, but I think a lot of them also speak to another level of detail behind what we've talked about so far in terms of the market, with upside, potentially limited, with downside potentially emerging as we see a little more relative weakness. But let's look at some of the individual charts together. We finished looking at the XLF and the XLU. I want to talk about financials, for example, and we'll look at Bank of America, BAC. So, if you look at this, if you zoom out a little bit, this doesn't look that bad, only because coming out of the March lows, you have this pattern of higher highs and higher lows for the most part. But what concerns me over the short term is you failed at the 200-day moving average. You've then established a lower high with the swing back to 26 that failed. And now we've broken down through the most recent swing low. So, charts like Bank of America, and there are other charts in the same sector, JP Morgan, Wells Fargo, American Express, Capital One, all of these look very similar to the chart of BAC, which is they've pulled back. They've now broken down through a swing low. The RSI has remained above 40, which, overall in a bull phase is where I would expect support. But that's if we're in a bull phase. And the problem is when a bear phase starts, when you have a new leg down, this is what it looks like before the thing starts to break down. So I think, watching these that have now broken to new swing lows and see if they remain there could give us a little color, especially in the financial sector. But it tells me with charts that are holding up a lot better in other sectors, I'd be certainly quite hesitant to be looking at a place like BAC at this moment, just given what I've seen. Now, compare that maybe to what we see within communication services. Something like Comcast comes to mind, in a similar sort of configuration where, it's broken above the 200-day moving average. It's pulled back a little bit, testing the 50-day. It's not really broken down too, haven't had much of a follow through after breaking down through that low from the second week in June. But it almost does look a little bit similar where the RSI has remained above 40 in a bull phase. Given everything else, this might actually be a decent viable pullback, but that's again assuming we're going to get a bit of a rally mode here, or we're able to continue the downtrend that happened when we tested those lows. So if you draw a trend line, these haven't really broken a trend line support yet. It's sort of holding above it. So this is why it's on a watch list for me, just to see if it holds or if it breaks lower. Now, other charts within here look very similar. Disney, again, looks a little more concerning because if you look at it, it feels a little bit more like the JP Morgan chart, which is now breaking down through support. It feels like it's done that. It's now broken down through the 50-day moving average. So feeling a little short-term weak, but the RSI holding at 40. So that's a consistent thing that we've seen all around. I'm sure you've all seen, obviously, the news flow with Facebook. Alphabet looks kind of similar to this, had really bad days on Friday. Today sort of, gapped lower, but then traded back into the range. So that's Facebook. This is Alphabet, which looks kind of similar as well. Both of these bottomed out on Friday with an RSI right at 40. So, it's interesting with a lot of these charts, I guess what I'm seeing as I go through them, they all have that same kind of configuration. They've either broken through their swing lows, which for me in the short term tells me we're in a downtrend, or it's attempting to hold those levels, but the RSI is hitting 40 and kind of stabilizing. If stocks like this have the RSI go below 40, that would concern me. If not, it's actually holding up okay, and potentially is a stable place of support. Now you compare that with something like Netflix. So there are plenty of charts that look kind of like this, sort of long and strong, pulling back to a buyable level within an uptrend, has not made a lower high, has not made a lower low, has not even had a divergence really to speak of, given the rally that we saw going into new highs last week. So a chart like Netflix is actually holding up really, really well compared to others. And I might bucket Amazon in the same sort of level, not really getting the divergence that we see in some of the other sectors, but sort of continuing higher. So remember this chart as I switch and show you some of the charts in big cap tech, and you can see why that's a little more concerning to me. Even though the price looks very similar, you can see the momentum characteristics are a little different. So charts like Microsoft, charts like Apple, while they came back up today very nicely, Apple up over 2% today, both higher highs in price, lower peaks in RSI. That's a bearish divergence. We have higher price and lower RSI, and that is what I'm seeing across the board within technology. So that for me on its own is not a signal to get out of a name like this, especially something that's had incredibly consistent relative outperformance. But what it definitely does do is put it on my my watch list to see if it's able to hold support or not on any sort of pullback, because that bearish divergence will happen, and it doesn't always manifest itself into a topping pattern. But you can see here, this is what we saw with a lot of these names in January before they had a bit of a higher push in February, or retesting those highs with a much lower momentum rating, and that ended up being a topping pattern. So instead of being just a straight drop, it's more of a topping process over 4 weeks or so. And so, potentially we're at the beginning of this. And so that's why I'm looking at a lot of the charts within big cap tech showing those or teasing those potential divergences there. Now, within healthcare, you actually have a really interesting mixed bag of things. I thought, while some of the sectors like tech, for the most part, just consistent uptrends, within financials, a lot of questionable charts across the board. Healthcare actually had a bit of dispersion, right? You had some charts that are actually holding up very nicely, some charts that are not. Within biotech, you have AbbVie, which has been just a consistent uptrend, testing the February highs, holding up just fine. So in no sort of breakdown, no real internal weakness. It's feeling like it's holding up there pretty well. I would say also in that bucket, something like Thermo Fisher would be a similar type of chart. Look at the RSI, just been in sort of the bull market range for a while, sort of long and strong up and to the right type of chart. Interestingly enough, Eli Lilly within pharma, a little different characteristic, but holding up very, very nicely. But you compare that to some of the other charts that you have, even within the same groups. So within biotech, where you have charts like AbbVie that look at that good, you have Biogen that looks like this. Within the big cap pharma space, you have something like Eli Lilly holding up very well. You have, or within the mega cap healthcare space, you have Eli Lilly holding up very well. You have Johnson & Johnson in the pharmaceuticals testing its 200-day, but certainly rolling over, making lower highs and lower lows in the short-term trend. So healthcare is actually a pretty an interesting sector where there are a lot of different charts represented there. Some charts like with energy, I could basically bring up any energy chart and it kind of looks like this. They all tested the 200-day. They've all failed. They're all broken down. It certainly doesn't seem like a great chart on a relative basis, starting to fold over a little bit. Literally almost every chart in the energy sector, especially the S&P, looks pretty much identical to this one. But within healthcare, within consumer discretionary, you have a lot more dispersion. So if you're thinking more as a stock picker, those are the places I would be looking. Within healthcare, within consumer discretionary, even within communication services, you've got some differentiation, right, between some stocks working, some stocks not. Some of the better ways to do that, if you have time to go through a manual process looking at the individual charts, that's what I tend to do. A shorthand way of doing that, use the screening tool, the scanning engine, or use the scooter rankings. Bring up the industry summary page, look at one of the groups, sort them by the scooter rankings, and look at the differentiation you can make using just that one metric. We need to wrap this show, folks. I have so much fun on Mondays going through these different angles. I hope it's helpful for you and you enjoy it as well, but we need to wrap the show 3 and 3. Here we go. Chart number 1 is the S&P by cap tiers, and this is a chart we've referred to often. As you probably know, I subjectively, very unscientifically, but consistently try to color code these once a week over Friday into the weekend. I'll change the colors if needed. And what I've basically done, it's just like a stoplight. The S&P cumulative advanced decline holding up okay, but certainly in a sideways pattern. Whereas the other breadth measures have broken down. Now today with the rally in small caps and mid caps, you'll see this bounce up a little bit, but it doesn't change the pattern of lower highs and lower lows. And that's what I'm looking at. It's not a day-to-day thing, but more the trends and how they're reversing. So those, in my opinion, speak to some internal weakness underneath the hood, while the S&P, led by some of those mega cap tech communication names, are actually holding up okay. Chart number 2 is within financials. And again, I've talked about a lot of different places. We talked about the Mindful Six on Friday. We looked at some of the individual names and sectors today. I think the XLF is a good chart we looked at today that I would keep aware of. And the XLF holding above 2250 would be, a great line in the sand if we break that. Again, I'm not a huge fan of financials anyways, but that would certainly, for me, open the door to much steeper of a correction, with the XLF going down to 220, if not even further. And the relative performance has certainly been brutal. So we talked about a macro chart. We talked about a sector chart. The third chart on the 3 and 3 is an individual name. We didn't talk about MasterCard, but this to me sort of tells the story of rotation. If I had to summarize the bottom-up process in one chart, it's a stock like MasterCard that rallied out of the lows, has broken above its 200-day, now has broken down below trend line support, is now sort of in consolidation mode, right? Sort of in this pattern of consolidation. Here we have a bit of a parallel downtrend of lower highs and lower lows, and it's testing the 200-day. Actually tested it almost to the penny today at the lows. The question here is a chart like Microsoft able to hold that? Stocks like this that break down, especially the Mindful Six that we talked about on Friday, keep an eye on those. If they hold those, I think the market's just at a decent pullback within an uptrend. If they start to break those, if you see an acceleration, I think you'll see people pile out of some of those positions very quickly. and there's further downside potential. Folks, that's our show for today. Thanks for joining us every weekday for the final bar, especially on Monday, for hitting the three directions of the market. Shoot us an email anytime with questions, thefinalbar@stockcharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.